So today's lesson is about a thing that we're going to call the multiplier. So what it has to do with is whenever we spend money, let's say I spend $1. Well, when I spend $1 in our economy, our GDP actually increases by more than that $1. And so all of this is going to become very important. And what's the word I'm looking for? It's going to become very important when we consider, I'm going to start over. So starting over here. All right, welcome to Unit 4, Lesson 4, about the multiplier. What we're embarking on today is we're going to learn how to determine how fiscal policy will impact the gross domestic product. And what we're going to start with is this. It's actually a very important concept. What percentage of your income do you spend? What percentage of it do you save? These two variables are going to determine what the multiplier is. So before we get started, I just thought I'd point out that in the United States, on average, we spend about 95% of our income, and we save about 5%. Those numbers, because it's an average, here's how it actually works. As you get older, you save more. Reason being is because you generally will have higher income, and so you need a lower percentage of your income to pay your monthly bills. However, when you're young, a lot of times your savings rate is negative. So it all averages out to about 5% savings, 95% spending as we go through the economy. Now, the reason that's important is because your savings rate determines what the multiplier is. So here's what I mean by a multiplier. If I spend $1 in our economy, our GDP doesn't increase by just $1. It's going to increase by more than $1. And the amount that it increases is going to be dependent upon this new thing we're learning today called the multiplier. So let's get started. Okay, first thing to note is that we have homework assignment. It is the KIA 4-4A multipliers, and then KIA 4-4B about vocabulary. The vocabulary lesson I want you to do as many times as you need to get a 100. The multipliers lesson, you can do it as many times as you want, but your first attempt is what will count as a grade. This is actually important. The very first part of this assignment is to create a chart on paper. If you don't create the chart on paper, it's going to mess you up because every question in the assignment deals with your chart that you create on paper. So the objective for today, and this is a shorter lesson, but the objective is that you will be able to calculate the multipliers. There's actually 3 of them. And then apply them to changes in real GDP as a result of changing in spending. And when we say spending, we typically mean government spending, but it doesn't matter who does the spending. And then tax changes, which obviously the government implements those. So let's roll on here. All right, first thing we need to know is there's some terminology, there's some variables that we're going to learn today. The first two are APC and APS. So what do they stand for? APC is the average propensity to consume. So this is simply the percentage of your income that you consume. Now, we use the letter Y to abbreviate income. Okay, so make sure you keep that in mind. So when we start writing out these formulas or equations or relationships for these things, you'll know that the letter Y stands for income. Okay, the letter C obviously stands for consumption, and the letter S is savings. So here's how you calculate these things. The average propensity to consume is consumption divided by income. Okay, so for example, if your economics teacher makes $50,000 per year and he spends $48,000 of it, then his average propensity to consume is 0.96. Okay, now this actually is a percent. All right, that means 96% of the income is spent. But for our purposes here, we're not going to express this as a percent. We leave it as a decimal. There's going to be a reason for that. Okay. Then APS, the average propensity to save, is the savings in dollars divided by your income in dollars. So if your economics teacher is making $50,000 a year and saves $2,000, then his average propensity to save is 0.04. So please note, these two numbers always add up to 1, okay? That 1 represents 100%. So here's another little lesson. What if this number was missing? You would still know that it's 2,000 because you can only do two things with your income. You can spend it or you can save it. So we know that if you spend 48,000 of your 50,000, then the rest of it you're saving. Okay? Here's another example. And this also happens. So earlier I mentioned that younger people will typically have negative savings rates. Well, and there's a reason for that. As you get married, you start a family. You know, it's very expensive and your income isn't there. So a lot of times you will actually spend more than you earn. And so that's possible as well. But we still do the exact same thing. So if your economics teacher makes 50,000 but spends 52,000, 52 divided by 50 is 1.04. So in this example, now our savings rate is negative. So whenever you go into debt, it's the same thing as negative savings or dis-savings. Okay? And again, these two numbers always add up to 1. Okay? Now that's just average propensity to save, average propensity to consume, and they are just there kind of to introduce us to these things, because these are the things that are actually important for calculating the multiplier. So the term MPC stands for marginal propensity to consume. And so this one's a little bit different. Now we're going to talk about the percentage change in your income that is consumed. Okay? Or MPS, the marginal propensity to save. This is going to be the percent change in income that is saved. So, for example, if your economics teacher gets a $1,000 bonus for helping kids pass, I'm going to treat that extra money differently from my normal salary. Okay? I might decide that I would like to save more of that for a rainy day, and I'll only spend $750 of it. So whenever people get additional income they weren't counting on, they treat it differently. So, you know, as an example, maybe you might get a lot of money for your birthday. Well, if you have a job, maybe you save and spend it differently than you will this extra money. Okay? So to calculate the MPC, the marginal propensity to consume, you take the change in consumption and you divide by your change in income. So my change in income is 1,000, and I spend 750 of that, so my change in consumption is 750. So the MPC is 0.75. And again, these two numbers will always add up to 1. So if I know what my marginal propensity to consume is, then we automatically know what our marginal propensity to save is. However, MPS is equal to your change in savings divided by your change in income. So 250 divided by 1,000 equals 0.25. All right? So let's roll on. Actually, let's go back for a second. This down here. Whenever you spend money, that money becomes another person's income. Okay? So when I spend $1, that means somebody else now has a dollar as income. And they're going to save part of that and spend part of that. So when they spend it, it's going to become another person's income, and so on. So this is kind of previewing the multiplier. All right. So the multiplier tells us by how much GDP will increase when our spending increases. So as an example, if we spend $100 and GDP increases, well, GDP will increase by more than $100. The amount that it increases will be determined by the multiplier. So if the multiplier were 4, for example, then $100 in spending will increase GDP by $400. Okay? So there are actually 3 types of multipliers. We're gonna look at the expenditure multiplier first. So this tells us how much our spending will increase GDP by. But there's also a tax multiplier. So this will tell us by how much the GDP will increase if taxes are cut, or by how much GDP will decrease if taxes are raised. So that's our tax multiplier. And then we have this thing called the balanced budget multiplier. And we'll explain that one as we go. But here's your formulas for these things. The expenditure multiplier, that's ME, is equal to 1 divided by your MPS, your marginal propensity to save. So the the percentage of your additional income that you save is what we actually need to determine the multiplier. Okay? Now, there's a couple other ways to calculate this, okay, because you're going to see that this becomes sort of a, there's a relationship between three numbers here. We've got spending, multiplier, real GDP. So another way to calculate the expenditure multiplier is to take your change in real GDP and divide by your change in spending. Okay, that'll get it to you as well. But we're not going to do it that way. You might see it, you might have to solve a puzzle where you're given the change in GDP and the change in spending. Then what's the multiplier? But that's easy enough to do. Okay? MT is the tax multiplier. You calculate it by taking your expenditure multiplier and subtracting 1. Here's another way. Okay? It is also your MPC divided by your MPS. Okay? You'll get the exact same number. I just find it easier to do it this other way. And then the balanced budget multiplier is simply 1. So that'll make sense as we do some examples with that one. Okay? So the multiplier tells us how much aggregate income changes with a change in spending by the government or by businesses or by anybody. Okay? Rolling on. So here's an example. All right? The government spends $200 billion on new highways, and our MPC is 75%. So let's talk about that. So if the MPC is basically 0.75, okay, then the MPS is 0.25, and then our expenditure multiplier, which is 1 divided by MPS, becomes 1 divided by 0.25, therefore 4. So what this indicates to us is that spending of $200 billion should increase GDP by 4 times $200 billion. So let's see how it works. So the government spends $200 billion on the highways. That $200 billion becomes other people's income. Okay? So the highway workers earn $200 billion. So this is kind of a simple example. Okay? These highway workers, because the MPC is 0.75 and the MPS is 0.25, these highway workers are on average going to save 25% of that income of the $200 billion, which is $50 billion, and they're going to spend 75% of that income, or $150 billion, on new boats. Okay? So we've increased GDP by $200 billion by new highways, and then the highway workers increased GDP by another $150 billion by buying boats. Okay? The boat makers are going to take the $150 billion in new income, and they're going to save 25% of it, which is $37.5 billion, and they're going to spend 75% of it, which is $112.5 billion, and they're going to buy iPod phones. Okay? So basically, just through 3 iterations of the spending, we're going to see GDP increase by 200 plus 150 plus 112. It's 112.50. So what does that equal? 350, 450, 460, 250. Okay? And we're not finished, by the way. The iPod phone makers now have $112 billion in income that they're going to save part of and spend part of. So it's going to continue on and on and on. Okay? Here is an example where we actually take it through all the way. So in this case, we're going to have an MPC of 0.5, which means the MPS is, let's see, that means MPS equals 0.5 as well, because they have to add up to 1. And that means that the expenditure multiplier is 1 divided by 0.5, which is 2. Okay? So the $1,000 in spending should result in GDP changing by $2,000. So here's what happens. Dallas County buys some hazmat suits. Apparently there was an outbreak of some disease recently, and so they buy the $1,000 on hazmat suits. The hazmat suit workers end up going to Disneyland because they want to get out of town. They spend $500 on that. Okay? Disneyland employees take half of that income and they save it. The other half they spend. So what do they buy? They buy new Labradoodles. Okay? The Labradoodle breeders are going to buy dog food. Okay? The dog food workers, they buy Frockets. The apparel workers spend money on zombie movies. Whoops, go back. And it just continues on and on and on and on until finally you have a fraction of a penny being spent. The whole thing adds up, though, to $2,000. So GDP increases by $2,000 when Dallas County spent $1,000. All right, so let's do some practice. Y'all follow along as we fill this chart out. Okay, so what we're doing here is we're just practicing. We get the numbers, and then let's see how it changes things. Okay, so MPC is 0.9. How did we get that? Well, basically we took our change in consumption and we divide by our change in income. All right, from the MPC we're going to get the MPS. So there's two ways of getting this: change in savings divided by change in income, or since we're not given income or savings, we know that MPC plus MPS equal 1. Therefore, MPC, well, 1 minus MPC will give us MPS. So our MPSs go all the way down here. First one is 0.10. Then we've got 0.20. Then we've got 0.25. Then we've got 0.40. And then we've got 0.50. Okay? So we needed MPS in order to calculate the expenditure multiplier. The expenditure multiplier is 1 divided by MPS. So let's calculate these. Okay, 1, make sure we understand how to do this. 1 divided by 0.1, that would be 10. Okay? 1 divided by 0.2, that'll be 5. 1 divided by 0.25, this becomes 4. 1 divided by 0.40, this becomes 2.5. And then finally, 1 divided by 0.5 equals 2. Okay? So this shouldn't be too terribly difficult. And basically what this is going to entail, see, you have to master this. So that means you got to practice this. And so this is a chart similar to what you will need to be doing in your homework. All right, so let's continue on. The tax multiplier, if you'll recall, is simply ME minus 1, or it's MPC divided by MPS. Okay? So this is pretty straightforward. So let's do it two ways. We'll do it the first way, expenditure multiplier minus 1. So when the expenditure multiplier is 10, we subtract 1, and we get 9. Okay? Let me just prove to you that it works the other way as well. MPC is 0.9. If we divide that by MPS, which is 0.1, we also get 9. Now, I'm going to erase this clutter so that we can just do it the simple way and roll on out of here, okay? So tax multiplier when the MPS is 0.8 is going to be 4. It's 4 because 5 minus 1 is 4. And then 4 minus 1 is 3. 2.5 minus 1 is 1.5. And 2 minus 1 is 1. Okay? So now we're going to apply these multipliers. Okay? So what we have over here, if you can just look at this box. Okay? What I'm implying here is that if we increase government spending by 20, there will be a change in real GDP of some amount that would be 20 times the multiplier. Or we could decrease taxes by 20 and GDP would change by some amount. Okay? So what we have to do when we increase government spending, we're going to multiply by the expenditure multiplier. When we reduce taxes, we're going to multiply by the tax multiplier. So let's do these together. 20,000 or 20 in government spending times our expenditure multiplier of 10 will be 200. Okay? See how that works? Now let's do this. $20 in tax cuts times $9 equals 180. All right? The next one, when the MPS is 0.2. That means the expenditure multiplier is 5. So now it's 5 times the 20 gives us 100. So if we spend $20 and the multiplier is 5, GDP will increase by 100. Okay, if we reduce taxes by 20, now we're going to multiply that by 4, so GDP will increase by 80. Now there is a little note here, okay? Or I should make a note. You need to recall when we studied aggregate demand, we learned that tax decreases increase aggregate demand and therefore GDP. So that's why I have a minus sign up here. Okay, we're basically creating negative taxes. So a tax cut increases GDP. If we increase taxes, GDP goes down. So make sure you keep that in mind. All right, so the next one, we have an increase of $20 in government spending times 3 is 60. Or we cut taxes by 20 times, whoa, I screwed that up, my bad. Whoops, so ignore that, blah, 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 blah. Put this back. I used the wrong multiplier. All right, so government spending increases by 20. We're going to multiply the 20 times 4, and we get 80. Okay? Then tax cut of 20, multiply that one by 3, and we get 60. Okay? We'll do the rest of them. Multiply 20 times 2.5. That means GDP is going to change by 50. Okay? Or cut taxes by 20, multiply that by 1.5. GDP increases by 30. And then finally, the last one, the multiplier, the expenditure multiplier is 2, tax multiplier is 1. So if you increase government spending by 20, multiply that by 2, and you get 40. Or cut taxes by 20, and you're going to multiply that by 1. GDP will increase by 20. So notice that the tax multiplier is smaller than the expenditure multiplier. That is because when people receive a tax cut, they're going to end up saving a portion of that before they spend it. So that's why the spending multiplier is larger than the tax multiplier. All right, so let's roll on out of here. Let's do an example. All right, so students go to Padre Island for spring break, okay? And basically, they're going to end up creating the multiplier. All right, they arrive at Padre Island with dollars in their pockets, and they spend a lot of money on food and drink, okay, motel rooms, etc. They'll buy pizzas and beer and sodas and who knows what else, okay? Anyway, they spend this money, and that money becomes income to the people of Padre Island. So as an example, if these students spend $8 million at Padre, and the MPC is 0.6, then that means college students will increase income in Padre by how much? So how do we do this? Here's what we're going to do. So if MPC is 0.6, that means MPS equals 0.4. Okay? That's not our answer. Then that means the expenditure multiplier is 2.5. Okay? Now we're getting closer to our answer. To get our answer, we take 2.5 and we multiply it by the 8 million. Okay, so 2 times 8 is 16. 1/2 of 8 is 4. So basically, when students spend 8 million, they increase the GDP of Padre Island by 20 million. So that's what we mean by the multiplier. Okay, so the answer is 20 million. All right. So here is some examples of how this will work. Okay, if the expenditure multiplier is 4 and the economy is in a recession, and the recession means that we are $60 billion short of full employment. So let's double check these. It says here that the full employment level of GDP should be 860. The current recessionary level is 800. That means this gap, there's a gap from here to here of $60 billion. Okay? So how do we close that gap using government spending if the expenditure multiplier is 4? Okay? So basically what that means is, and I've got a kind of I'm going to call this the Walden rule. The reason is because I haven't seen this expressed in any textbook, so I'm calling it my own. All right? Here's how it works. The change in government spending times the expenditure multiplier will equal a change in GDP. Okay? We can look at it this way as well. The change in taxes times the tax multiplier also will give you your change in GDP. So we'll do both ways. All right, so the expenditure multiplier is 4, right? So let's put our 4 right here. And what we're trying to find is our change in government spending. We know how much we want GDP to change by. We want it to change by this 60. Okay? So now all we do is a simple algebra. How much should G be? Okay? The government should increase spending by 15. Multiply that by 4, and that equals 60. So if they increase government spending by 60, aggregate demand should shift to the right enough to close the $60 billion gap. Okay? If, on the other hand, we wanted to do this with tax cuts, you got to remember negative taxes increase GDP, positive taxes decrease it. So our tax multiplier is 3. We still want GDP to change by 60, and so that means that we should cut taxes by 20. Okay? And then basically our final answer will be some absolute value, because that's what it's going to change by. Okay? Sort of makes sense? Now, let's go through the mechanics of how this works, okay? So through this process, what we're doing is we're increasing government spending, okay? That's going to lead to an increase in aggregate demand. The increase in aggregate demand, see how it shifted over here to the right, brought us back to full employment. Okay, that's going to lead to an increase in income, employment, and price level. Okay? The other thing we could do, of course, was what we also did was lower taxes. When we reduce taxes, that increases disposable income. When disposable income increases, it increases consumption. When consumption increases, aggregate demand shifts to the right. Okay? And we get the same effect. Income, employment, price level all rise. So we're back to full employment equilibrium. Now, here are some side effects. Okay? This is one of the criticisms of fiscal policy. If the government increases spending, what that means is they either have to increase taxes or they have to increase borrowing or printing or whatever. So we're going to make the assumption that they want to be expansionary, so they're not going to raise taxes. Instead, they're going to borrow money. So this increases demand for loanable funds. And that, in turn, increases interest rates. Okay? Same thing with tax cuts. To finance tax cuts, we're going to increase demand for loanable funds, and that also is going to increase interest rates. Now, let's go back. Let's talk about loanable funds market. Okay? I just threw something new at you. So let's look at the loanable funds market. All right, this is simply a market where funds are bought and sold. Okay? The price of these funds is the real interest rate. And then we have quantity of loanable funds. We have a supply of loanable funds and a demand for loanable funds. And we label it as the loanable funds market. So the word loanable, you'll see that it's not really a word except in economics. All right? Now, let's talk about the characteristics here. The supply of these loanable funds, okay? Think of this as people who save their money, okay? When you put your money in the bank and you save it, it's available for other people to borrow, okay? The demand is going to be made up of the borrowers, okay? So let's talk about these a little more. So what I just mentioned to you is that if the government increases spending, they have to borrow money to do that. So let's show what happens. Since the government would become a borrower, That means when they want money, they have to increase the demand for loanable funds. Okay? When they did that, it increased interest rates. Okay? Interest rates were here. Let's call it rate 1. And now they are here. That means they went higher. So why is that important? Okay, the reason this is important is because we learned that when interest rates increase, it leads to some things like this: less consumption, less investment. Okay? It also will appreciate the dollar. Okay, so the dollar gets stronger, which means exports go down. Now, so that's a pretty heavy side effect. Okay? So while government spending increases aggregate demand, the fact that interest rates rise will end up reducing it. So I wanted to point that out to you guys. Okay? This process, or what we just described here, is called the crowding out effect over here. When interest rates rise as a result of government spending, we call it crowding out. Okay? It crowds out private consumption. It crowds out private investment. Okay? All right. Look, you know what? We should analyze one more thing about this graph. So, savers. Okay? Anytime we increase savings, then the supply of loanable funds will increase. If we decrease savings, the supply of loanable funds will decrease. Okay? So that's important as well. If we increase our savings, look what happens. Interest rates will fall. If they were here and now they're here, so they would fall. Okay? If we decrease savings, interest rates could rise. All right, so let's roll on. I wanted to make sure we understood that. You are going to be responsible for drawing that graph very soon. Okay? Loanable funds market is going to be crucial. All right, let's do another example. Okay? So we have a very similar looking economy, except now we have to calculate what all of these variables are over here. Okay? So let's draw what an economy in this situation would look like. Okay? So we would have obviously an upward sloping aggregate supply curve, okay, and a downward sloping aggregate demand curve. Now, if it says that we are short of full employment GDP, okay, Y star is the full employment level of GDP, and we're short by 60 billion again, that means our equilibrium has to be somewhere to the left of the long run aggregate supply curve. So I'm just going to make it right here. Whoops, I was off a little bit. Okay, we're right there. Now, that means here is where we have our economy currently. So again, we're sitting on a $60 billion gap. Okay, the distance from here to here is 60 billion, and we want that gap to close. Okay. So the question over here is, by how much should government change or taxes change? So we're given some information. Okay, the change in consumption is 900. The change in income is 1,000. So if we increase, if our income's increased by 1,000 and consumption increases by 900, we have $100 left over. So what is the $100? That is our change in savings. Okay. Now, marginal propensity to consume is going to be our change in consumption divided by our change in income. Okay. So our change in consumption was 900. And our change in income is 10. So I'm just going to use some shorthand here. Okay? That means our MPC is 0.9. Our MPS, well, there's two ways to do it. You can take your change in savings over your change in income. Okay? So we could do change in savings over change in income. Or we could just do 1 minus MPC. Okay? So if MPC is 0.9, that means MPS must be 0.1. Okay. Expenditure multiplier is going to be 1 divided by the MPS, so 1 divided by 0.1, so it's 10. And the tax multiplier is going to be 1 less than the expenditure multiplier, so it is 9. Okay. And then let's write down our Walden rule again. The change in government spending times our expenditure multiplier will give us our change in GDP. Or change in taxes times the tax multiplier will give us our change in GDP. You just have to remember which direction taxes go, okay? If taxes are cut, GDP goes up. If they're increased, it goes down. So now we're going to go ahead and solve our problem. If the if the expenditure multiplier is 10, okay, let's see, we want our change in government spending times our expenditure multiplier to equal our change in GDP. And we want GDP to change by 60. And our expenditure multiplier is 10. Then it becomes what times 10 equals 60. So our change in government spending should be 6. Okay? Or if we do it the tax cut way, change in taxes times our tax multiplier will equal our change in GDP. And again, we want GDP to change by 60. And our tax multiplier is 9. And so now 9 times what will give us 60? What? You know what? I didn't have a calculator, but I'm going to guess it's like 6.67. I should look that up. All right, calculate. I don't want any incorrect answers here. So 60 divided by 9. Yeah, 6.67. So to solve this problem, if we increase government spending by 6, or if we reduce taxes by 6.67, the AD curve will shift and bring us to a full employment level of GDP. So we have solved the crisis. Okay? Now this seems very, very simple, doesn't it? It's supposed to seem very simple because this is a simple model to explain a complex economy. In reality, the multiplier is very hard to figure out what it actually is. Because if you'll recall, several years ago, in a recession, our government spent $1 trillion and GDP didn't really move. So it's hard to gather exactly what it is, but sometimes there's other forces at play, and so you just never know. Okay? But this is good to learn as a theory. Okay? So now we have another situation. It says here that there's an inflationary gap of 200 billion. Current GDP is 1,200 billion. Whoa, current real GDP is 1,200 billion. Okay, there's a mistake here then. Oh, no, never mind. That's right. Okay, so let's draw an inflationary economy real quick. We have AS. If it's inflationary, that means our equilibrium is somewhere to the right of the long-run aggregate supply curve. So our aggregate demand must cross right there, and this level of GDP is 1,200. Okay? So that means our current gap is 200. And so that we want GDP to actually get smaller now. So, a couple things we already know. Okay, we know, just from learning, that we are going to need to either decrease spending or increase taxes. The question becomes, by how much? Okay? So let's fill out these things over here. We've got a change in consumption of 80. Change in income of 100. That means our change in savings is 20. Okay? 100 minus 80 gives us 20. All you can do with income is save or consume. Okay? MPC is going to be 8 over 10, or 80 over 100 really, but I'm saving space. So 0.80. If MPC is 0.80, MPS is 0.20. If MPS is 0.20, ME is 1 divided by 0.20, which is 5. And then the tax multiplier is going to be the ME minus 1, so 4. Okay? So now we have a spending multiplier of 5, tax multiplier of 4. So now we're going to apply the Walden rule again. And it says change in government times the expenditure multiplier will give you your change in GDP. Okay, we want GDP to change by 200. Okay, so we want to reduce GDP by 200. that means we should reduce government spending by some level, okay? The expenditure multiplier is 5. So what times 5 will give us negative 200? I say, whoa, negative 40? That should be right, okay? So if we decrease government spending by 40, that should fix it. Or change in taxes times the tax multiplier is going to equal our change in government. Tax multiplier, safe space. Tax multiplier is what? 4. So 4 times what equals negative 200? Well, forget the negative part. We just have to know that taxes are going to go the opposite way. So it's 50 times 4 equals 200. We just have to make sure we know that we increase taxes by 50 to get us negative 200. Okay? So if we increase taxes by 50, that'll do the trick. So we could do one or the other, and we fix the economy. We solve the inflation problem. Okay? So that's how that works. Good examples. All right, next. We're going to do one more. It says here we're in a recession now. Okay, we're in a recession. Our current level of GDP is 1,000, and it is $100 short of full employment. So we're going to do the same thing. I'm going to go quicker this time. Okay, this time we're given our change in income and our change in savings. Okay, income increased by 1,000, savings increased by 200. So consumption must have been 800. Okay, that means our MPC is 0.8. That means our MPS is 0.2. That means our expenditure multiplier is 5. Tax multiplier is 4. So let's see what the economy looks like. Okay, we are short by 100, so we'll make our equilibrium to the left of the long-run aggregate supply curve. Okay, so 1,000. Our gap is 100. So now the question becomes, how much should we change government by? Okay, or how much should we change taxes by? So here's what we should do. Let's see. Our expenditure multiplier is 5. So 5 times what will close a $100 gap? Okay, you should increase government spending by 20, because 20 times 5 is 100. Or taxes. We should decrease taxes by 25, because 25 times 4 will give us 100. So if either of those two things are done, boom, we solved the recession problem. Okay? Very, very straightforward once you practice it. Okay? This is what I wanted to get to. Okay? We're going to now look at the balanced budget multiplier, and we're going to explain how that works. Okay? So the big rave in Washington is that we have all kinds of debt. Okay? So we want to fix a recession this time without increasing our debt. Okay? In order to do that, that means we have to present a balanced budget. Okay? So let's fill out some numbers. All right? Well, gosh, we don't have any numbers. We just get to make them up. That'll be fun. So let's make them up. Let's make it fairly straightforward. Okay, we'll do this. Consumption goes up by 80, income by 100, savings by 20. That means our MPC is 0.8, our MPS is 0.2, our expenditure multiplier is 5, our tax multiplier is 4. The balanced budget multiplier, it is always 1. The reason it's 1 is because it is always the ME minus the MT. Okay? But it is always 1, so you don't have to worry about that. Now, let's go ahead and fix this economy. Let's see, how do we do this? Well, we're going to fix it using the balanced budget multiplier because we don't want to increase the debt. Okay? So again, it'll look like this, okay? There's sort of a Walden rule for this as well. We could take our change in government spending, okay? And by the way, that will also be our change in taxes, so we could treat this as like its own entity, all right? And we multiply that by our balanced budget multiplier, which is just 1, and that'll give us our change in GDP. So let me explain how that works, all right? First of all, we know that's 1, And you know what? Let's figure how much do we have to change it by? Current GDP is 2,000. It should be 2,500. So we have our aggregate supply curve. We've got our aggregate demand curve. This level of GDP is 2,000. So we want to close a $500 gap. Okay? By the way, it gives us other information. We might as well graph it. Unemployment rate's 12%. Let's put that here. It doesn't really tell us inflation, so we don't care about that. We want to get to a point where unemployment is 6%. Okay? So let's do it. What times 1 will close a $500 gap? Oh, you say 500. There you go. So what that means is we have to increase government spending by 500. Okay? So let's write that down. We're going to increase government by 500. In order to pay for that, we have to raise taxes by 500. Okay? That's what gives us a balanced budget. Okay? That creates the balanced budget, meaning we will not increase our debt. Okay? So let me show you why it's always 1. So what I'm going to do is I'm going to increase GDP by 5 times 500, okay? Because that's going to be our expenditure multiplier. So 5 times 500 is 2,500. So I'm going to say it goes way over here, okay? And this would be a level of GDP, if it increased by 2,500, this is 4,500, okay? Then we're going to take our tax multiplier, because we raised taxes by 500. So 4 times 500 is 2,000. We're going to decrease GDP now by 2,000. And so now we are fixed. So basically, this is what happened. The decrease in government spending increased GDP a lot. The increase in taxes brought it back. Okay? So that's why it is that if you increase government spending and taxes by the same amount, GDP will increase by 1 times that amount. Okay? So that's what is meant by